Hi, I'm Simon Rodrick from Fram Search, and I'm delighted to be joined by Mason Doick from a really interesting firm called JP Jenkins. Mason, how are you today?
I'm very well, Simon. Thank you for having me.
That's quite all right. And are you in the office today or are you working from home?
Yes, I'm in the office. Yeah, we're pretty much in the office 24/7, even through COVID. We were sneaking in where we can. So yeah, no productivity for me is not great at home. So I've got to be in the office. But we're West End now. We were city based, but we just moved.
Good for you. I know, and do you know something? I think we're seeing a return to offices actually more and more. That's been the theme over the last few months. And I think when people were able to, and whatever within the rules, people were going back to offices quite quickly to re-establish. I think it's the relationships with colleagues, isn't it, that you miss?
Exactly, and no, I think it's ironic that we're sat on a Teams meeting, but I was going to say that it's one of those things where I actually prefer, and I think most people do, the face to face. And the other day, people called me and I said, actually, let's just have a phone call, let's catch up for a coffee. Gone are the days of the Zoom and Teams that we've done for 2-3 years. But as I said, ironic that we're on here now, but it helps with the bringing people together, I guess, that are all across the UK and the world.
There's a place for it, isn't there? So,
Yeah, that's it.
without further ado, as I said earlier on, I think you guys have got a very interesting business. Would you mind telling us about JP Jenkins?
Yeah, sure. There's so much to fit in, and I'll try and cram it in, a couple of minutes. But JP Jenkins, as you said, has been around for a very long time, so 32, 33 years. We launched in around sort of 1991, but our roots can actually be traced back to the unlisted securities market, so going back even to sort of 60s, 70s, 80s. And really, JP Jenkins at that time in the 90s, was the market maker for OFX. OFX was the off exchange trading platform for unquoted securities, with JP Jenkins being the market maker and supporting some really, really nice businesses like Adnams Brewery, Weetabix, National Car Parks, pretty much nearly every Premier League football club at the time, other than one or two. Because all of these shareholders and fans wanted to transact in those shares, wanted to have a holding of those brands within the UK. And over the years, OFX transitioned into a number of different markets. It was Plus Market, the next market now is Aquis, which we're not part of, but we work closely with where we can. And JP Jenkins spun out from that a number of years back and became the match bargain facility that we are today, which purely means that we can match willing buyer and willing seller on a bulletin board-esque platform to support unquoted or private companies in trading their shares. So very, very simple mechanism, matching those shares or those trades or those orders. And it's the same infrastructure as the LSE. So broker to broker, as you would with your Hargreaves Lansdown, AJ Bell interactive investor account, place an order with us and we can get those across the line. And the really exciting thing was back in the 90s and early 2000s, OFX was a huge player in this market, supporting hundreds of companies, as some that I previously mentioned. It also raised over £1 billion at that time, and the liquidity within that market was incredible in comparison to maybe what you may see in capital markets today. The costs, for companies as well is quite, and we'll go on to this in the call, but the costs are very fractional with the match bargain facility and JP Jenkins in comparison. Onboarding and monitoring is there, but it's fairly light touch in regards to the comparisons of capital markets. And funnily enough, I was having a number of calls this morning with different private equity providers, institutional investors, brokers, and they were saying, well, actually, the valuations are much better supported in a private market, and you don't have that price volatility and macroeconomic effects on those businesses and that share price, which, as you're seeing in the UK markets at the moment, with everything going on with the banks and wider and further afield. The good thing about it, Simon, as well, is obviously there's a lot of overseas companies that we're seeing that are doing really, really well, lovely businesses, and the UK markets would love to attract them to a UK listing. And it could be a price point, it could be other barriers to entry at this moment in time. But cross-border listings is also something we're heavily looking at, giving those investors, shareholders and companies a UK exposure, widening that investor reach for those companies. So the platform really lends itself to a whole plethora of opportunity. It's not just sort of a match bargain facility in the sort of small scheme of things. It's more so that companies can use it to leverage M&A activity. They can use it for credibility and building out that corporate governance on a third-party platform to have a visible price. It could be that they're purely looking to engage a wider investor network for primary capital raising, albeit that we don't directly do that through the platform. So really lovely business, very great provenance for about 20, 30 years at least, and just looking to build that on and bring back JP Jenkins Evolve back to what it used to be.
And I think probably something that a lot of entrepreneurs aren't probably aware of as an option in terms of growing your business. I mean, it sounds to me that in a nutshell, you're providing liquidity to what is often seen as an illiquid asset class, i.e. private companies. And I think, as somebody who runs their own business, you often think about, well, down the line or as you get bigger, you're told, aren't you, that the right thing to do is to go from being a private company to listing at some point. And of course, that's not for everybody, is it? So I guess my question would be, what are the pros and cons of a public listing versus a kind of JP Jenkins solution?
Sure. And just, I was going to say something just before I mention or talk about that or answer that question. It's so true. I worked in several years of private equity and small cap markets and allocating funds of investors on a discretionary basis, and self-execution, and those companies, whether they be on the lower echelons of a junior market or remaining private indefinitely, do not have any liquidity whatsoever. You have some really great investment schemes like EIS, SEIS, but even with those schemes, we find that there's, I think, about 29 billion in 35,000 companies, which is locked up. And really, the JP Jenkins sort of vision is to unlock that capital, recycle it into new ventures, and support continuous growth businesses coming through the UK to support that growth, but not only provide those pre-existing shareholders, investors, or early stage family and friends that put their first checks in with some sort of payback or an opportunity to cash out even a small portion of that investment or equity. So exactly that is providing that liquidity mechanism for all companies and all individuals involved within these businesses. In terms of the pros and cons, there's so much you can find online and from advisors on the benefits, and companies always get to that point where the colleagues or the shareholders of the board are saying, actually, well, when is the right time to go and list, if that is the end goal? And on that note, I guess most companies I come across will never plan to list. I think sort of 70-80% of the businesses I worked with are always looking at alternative exit routes. But of those sort of 10, 20, 30% that do look to list, there is obviously the whole stages of going towards a listing that they need to sort of prepare for, as it's not sort of a simple transition. I guess businesses usually go public to raise capital, they want to expand, but then they are faced with lots of different sort of hurdles and opportunities and challenges to deal with. So the first one, I guess, goes back to our point around cost. IPOing and going to a listing is not cheap. Poorly timed IPOs are also extremely detrimental to the company and their financial growth and stability, which we saw last year with Deliveroo and other businesses that went to market. I guess on that point, with JP Jenkins, you've got the benefit of using it as an incubator or a facilitator towards a listing and then being able to IPO when the time is right. We have a number of companies actually looking to go to AIM and NASDAQ this year, and just waiting for the right time in the market to make sure that that's a perfect timing, hopefully, for them. I know everyone can't time it perfectly, but the best opportunity in place. So taking into account costs, I mean, looking at and don't hold me to this because I don't know the exact number to the decimal point, but AIM and an LSE can be, upwards of 2, 3, 4, 500,000 pounds for a listing, and to maintain that listing could be 100, 200, 300,000, and that's taking into account all of the costs, so advisory costs as well, and the prospectus. Then looking down the junior markets and looking maybe at sort of AIM, or not from AIM, but AIM and Aquis. Aquis is around sort of 100 to 300,000 to list or IPO, and I guess another 100 or so thousand to maintain that or two every year. We've had some companies that have come to us and have said, actually, well, we spent sort of £600,000, £700,000 on a listing, but we didn't actually see a huge amount of liquidity. and there's only a very tightly held cap table, so there's not a lot of shareholders, so it doesn't actually make sense for that listing to maintain, and they're better suited to be in a private environment through a sort of a match bargain facility, which is what happened to Stanley Gibbons or some of the other sort of well-known brands that came off market and joined us last year. The other thing that companies need to take into account is the financial reporting and monitoring. So with obviously public markets, you have to provide, obviously make sure to verify all the information and the data is public. Also, the board members, directors have disclosures and standards which they have to adhere to. You have the periodic audits, which are very expensive now because audits from KPMG and PwC and everyone we've spoken to recently is dramatically gone up in price. I think it's nearly doubled this year. And there's a lot of scrutiny that can be brought to those companies from shareholders and investors as well. So companies really need to bake that in and make sure that they're prepared and ready for that, and that they can allocate time. And that segues on to sort of the third point, is around distractions caused by IPOs. So there are companies that I've seen that do incredibly well with their IPO, and they're maintaining their listing, and their data rooms are perfect. They provide really clear, transparent guidance on where that business is going, and a lot of regular reporting, which increases the liquidity in trading. But it is a significant undertaking. Board members need to be aware of obviously putting energy into going public. And I think in most pre-IPO programs that you see through different advisors, it can take at least 6 to 12 months for that IPO to come off. The one thing I mentioned about sort of timing wise as well with the market, and given that the last 12 months has been quite difficult for any IPOs to become successful or even be an IPO. Investor appetite, every company has masses of shareholders and followers, maybe investors, but they're not always chomping at the bit to buy that stock, and making sure that the market is right. There is investor appetite, there is interest there, the market knows, or the company knows it's going in the right direction, and it's expressing that clearly to the shareholders or interested parties. It makes a massive difference in terms of when the IPO is going to be successful. We see a lot of the companies going to listing, and then as soon as those lock-in periods end, obviously the shareholders and investors sell out, they get a premium, and it can drive that share price down. So one of the things we see with JP Jenkins is you can actually prepare for a more successful IPO, manage those shareholder expectations, manage that trading flow, and then when the IPO comes to fruition, there is obviously a more tighter cap table and a more cohesive, I guess, cap table for the future of the business. So sort of covering all of that, the benefits are that in theoretical sense, a company can raise significant capital and hopefully attract institutional investor if they go list. They have an easier time to attract top talent, and it's an easier sell, I guess, as a consumer product, or depending on the type of business, to other companies or other investors or institutions that they're listed on a recognised exchange in the UK or overseas. It provides obviously much more opportunity for visibility, publicity, media coverage. I guess they get a more opportunity because they can say, well, we're listed on an exchange. But taking that into account, obviously the decision to go public needs to be thought of quite thoroughly. We have a lot of companies we speak to each year that spend a huge amount of money on listing, only to be told that they didn't raise the significant amount of money that they're looking for, or the IPO wasn't successful, or they had to pull the IPO for whatever reason, different variables, and they lost a huge amount of money going through that process. And really, if we can help them with building out that corporate governance, that pre-IPO sort of trading venue as such, or liquidity, manage those shareholder expectations, build the foundations for that company in a private environment, it makes much more for a better IPO moving forward.
Yeah, I think there's a lot of points there that you raised that are really interesting. I mean, obviously, there is absolutely, as we all know, the right time and great opportunity that comes with being listed. It's very easy, as you said, right, it's easier for firms to advocate why you should work for them when they're in a listed environment. It generates a lot of excitement around the business. But a couple of points that you mentioned there is, we see the other side. So we see the requirements that are put on businesses when they're listed, and therefore the amount of extra staff that they need to meet those requirements and reporting requirements, and the costs that go with that. And the other thing that we always see is, whether it's somebody preparing for an IPO, or indeed it's a new piece of legislation or regulation, is whenever something new comes into the kind of ecosystem, management time is taken up by the new project, and actually firms can take their eye off the ball, and management teams, with the core business. It's inevitable that, you know, we're all human. We've only got so many hours in the day. Your time gets stretched, and you can see it being a bit of a distraction for firms. As I say, we see it all the time. Legislation coming in, you know, a big piece of legislation comes in, and you can see that management teams will have quite a tough period, and their business wills they adjust. And I guess the final point that you make is, you know, we had a lot of volatility lately in public markets. You're getting a price every few seconds or minutes on your instrument, and therefore that can make appetite from investors kind of really gyrate, I think, quite significantly.
There's been so much happening. I mean, over the last, I mean, it can go back sort of pre-COVID. You know, there was a real flurry of investment in 2021. Capital raising became easy for private companies. Companies then pushed for a listing in 2020 or 2021. And then they found last year that, well, there wasn't that capital there. There was no money to continue those follow-on rounds, raise further funding, secondary raises on public markets. IPOs completely sort of died in the last 12 months. And I think companies have really reviewed whether or not it's right to list at this moment in time. Given the fact you're now seeing obviously the sort of issues with UK banking and overseas banking, and there's a very fragile system in place where panic can cause a lot of concern. A lot of investors have been sat on their hands for a long time. And I guess that's just, it's flowing through the capital markets at the moment. I think if we can support those businesses at a much more fractional cost and support them until the time is right, because I think the nice thing about JP Jenkins, and a client said this to us recently, they're purely using us as a sounding board. We're not incentivized by allocating to particular advisors or costs or fees on that. It really is about making sure the business is suitable and right for a listing or providing a service until there is an exit option available elsewhere. And I think looking at the state of capital markets and private markets, there's a perfect need and fit for this. And the bottom 25-50% of AIM and Aquis, we see a lot of those companies are really small market capitalized valuation businesses that are paying every penny in revenue to maintain that listing. And really what we're saying is, or they're saying to us is actually, we can raise in a private environment at a better valuation. We can save 2, 3, 4, 500,000 pounds on costs, and then we can look to relist when the market is right and the time is right and the business is of scale or size and they've built critical mass to do so. And we had a perfect couple of examples that companies that came off market in 2019, they saw their share price double in about 12 to 18 months on JP Jenkins, a huge amount of trading, which actually was surpassing the trading they had on the UK listed market. And then they're looking to relist on a market in the end of this year or mid to this year, So, there is an opportunity, a huge opportunity there, and I think that's something we can definitely help.
And are firms, Mason, that come onto a platform like JP Jenkins at some point looking to list, do you think, or could that be a long-term solution to stay on the JPJ platform?
I think there's a mix of both. I think we will always have 20-30% of the cohort that will always look to list, whether it be in 12 months or 5 years' time, which is perfect. And JP Jenkins completely lends itself to those companies because they get their ISIN code, they get their registrar in place, they get broker to broker trading, so they're pretty much set up to list, and the transition is very easy. But even that sort of 50, 60, 70% of the cohort that remain private, they will still have a venue for transacting in their shares. They won't have the price volatility, and they can remain private until they're looking to do a trade sale or an MBO or whatever that may be. So I guess there's the option of putting essentially giving the company the option to decide on what is right for them at their size and scale and time and growth journey.
So say, for example, somebody's running a high growth company at the moment, and they're thinking about, either taking risk off the table or growth capital, or one of the many reasons why you may list. Who are the people who should be listing? And what are the alternatives for those that feel that they're either not quite there or they don't meet the characteristics of those that should be listing? I mean, what's your view on that?
Well, I think we see anything that's sort of sub 10, 20, 30 million on junior markets does struggle with raising external capital. There's lots of variables,
Okay.
There's lots. It's difficult to because I know as soon as I say that there'll be other cases where there'll be really good cases of other companies that have done well. So there's lots of variables to take into account, but most businesses that say sub 10 million really, I don't think should be on a UK market. They are really struggling with liquidity. There's, as I said, hundreds of £1,000s worth of costs on that business, and the stress and pressures and monitoring on that business. It doesn't make sense, as you said, for those boards and that management team to allocate 60, 70, 80% of the time just to maintain that listing. And they're sort of in that spiral of death where, unfortunately, you see a lot of those companies just slowly dying because they're paying out these fees and never focus on growth, and it doesn't make sense for them to maintain that listing. And funnily enough, there was actually a couple of companies, well, not funnily enough, but there was actually a couple of the companies we speak to recently where they're, hugely, and I was talking to a broker about this morning, is that, they're hugely discounted on their cash values in their bank on the balance sheet because they're listed. And usually that provide years ago a growth opportunity for institutional investors to get involved with. But at the moment now, nobody's actually touching those opportunities, and everyone's sort of sat in their hands because they're unsure about where that business is going to go and where the market's going to go. But I guess it depends. So as long as companies have got a good understanding of the capital markets, they understand the length and the process of the IPO journey, they have great advisors or individuals on board that know that route to market in that sector, in that area, and they are making good routes towards pathway to profitability or revenues. They've got critical mass. Then it makes sense. But it's what I fear is that there's lots of companies that are being pushed to list too early on. They're potentially revenue generating, but not of significant critical mass. They don't have a great sort of amount of credibility or corporate governance or visibility to provide a stable ground for a listing. And I think those sort of companies, then they should be looking at alternatives. So when we speak to accountants, lawyers, advisors, they have huge cohorts of companies that are just too early to list. And what we say is, well, actually, we can work with them. Any of those sort of pre-IPO companies that haven't got the foundations in place and need some more guidance, we can work with them for 12 months, 18 months, 2, 3, 4, 5 years to support them, and then hand them back to the advisors, the accountants, the lawyers when the time is right to list. And we're finding those companies, 10, 20, 30, 40 million. But then there's even some companies now that are 60 to 600 million that are saying, look, we've seen the state of the capital markets. We've seen competitors list that have just crashed in terms of 50, 60, 70% share price in the last 12 months. And they just want a venue which is a way in which they can transact their shares, but they're not going to be scrutinized to high heaven, and build out those foundations. So that we're supporting a long list of companies. And they're really wide ranging, so it's hard to put sort of categories and silos. And some of those businesses are 1 million market cap, some of those businesses are 200-300 million market cap with revenues ranging. But I guess the point is that any company that we speak to needs to have recurring revenues, needs to have a number of years of history or trading history, and to have a functioning match bargain facility in place. Obviously, they've had to have gone through a number of rounds of funding to have those shareholders in place for it to make sense, commercial sense for them to have that trading venue for them as well. So I guess each individual case and company is taken on its own merit, but there are options available to them, and I think JP Jenkins plays into that area.
But I know the financial services market well. Well, I hope I do anyway for my job. I'm not really aware. I mean, are there any other people doing something similar? I mean, is this a competitive space? Was it unique? Or
it wasn't as competitive a number of years back, but it's become very, very interesting for lots of larger institutions, even larger markets. There's the US in comparison. Secondary markets are huge, mainly more for bigger ticket size companies with big blue chip names. And they're transacting in large secondaries, direct and indirect, off the cap table. There's also secondary funds. So they're in the US, it's obviously multi-billion-dollar secondary market over there. In the UK, you've got sort of crowdfunding platforms providing very small secondary transactions, but the volumes are quite small, and the tradings are Mr. and Mrs. Smith transacting one share here, one share there. So it can be a bit difficult, I think, personally, for the shareholders or investors transacting through them. The costs are quite heavy. So, if you're transacting in the secondary market on the crowdfunding platform and there's a 6.5%, 7.5% retained profits fee, there may be other fees in there as well. It can be quite costly for an investor who's only transacting a number of shares at a very small volume.
Right.
And then you've got other providers. So, over the seas, in European countries, I think there's different sort of platforms and providers that do some sort of tokenization trading or secondary market-esque platform. So there are lots of companies coming into this space, trying to sort of revamp the technology around it. Gone are the days where JP Jenkins used to do the STX line and over the phone orders, whereas now we've actually been acquired and we're working with a group called Infinitex, who now provide and plug in the technology that we can work with the brokers and use their systems to simply plug in digital transactions or orders. So it makes it a lot more easy for them to have oversight and transparency on the orders on JP Jenkins, but also then, of course, it brings us up to the 21st century with our technology as well.
Yeah, absolutely. No, Mason, that was really interesting. And thank you for talking me through that. I ask everybody who I talk to what their view of the economy is. So we are talking to sort of timestamp this conversation post Credit Suisse and post Silicon Valley Bank, all those other things. I had been very positive about the economy and the recovery we're seeing. And I'm going to stick with that and say that, assuming that there's no surprises that fall out or continue to fall out from those two incidents, that I feel that confidence is coming back quite nicely. What's your outlook on the economy for 23?
It's a difficult one. It's very choppy at the moment.
It's changed the last few days, hasn't it?
But yeah, it's very choppy. So I guess the fallout from the banks is a difficult one because they're very fragile and archaic in some cases. So there can be panic can transition and change quite rapidly. I guess there is a positive sentiment coming back. We've got, I believe, or I can see that there is potentially capital markets in the UK improving. Unfortunately, there are really nice businesses in the UK going overseas to US markets, which you saw with ARM and CRH and Ferguson and many more. And I hope that in time we can really improve both, the markets review of the UK and potentially attract more interest and to retain those companies, but also through the likes of JP Jenkins and other businesses provide an incubator or feeder for those markets as well. But it's a difficult one to comment on. I guess private markets will always continue to do well because you have the incentives via the VCTs, the EIS, the SEIS, tax reliefs and benefits and capital allowances. And loss relief, of course, as well. But I think, capital markets has been fairly tumultuous over the time. And hopefully, I think we are moving to a better step. I think most people were hoping that capital markets would sort of resurface sort of end of this year, Q3, Q4. IPO market will, pick up at that time. And that's sort of being optimistic on the situation. But I think, it just depends on how the next sort of couple of weeks follow, and obviously following from the budget.
I echo your sentiments entirely about EIS and VCT. I think it's been a wonderful thing for private companies in the UK, really incredible. And we work with a lot of firms in that space, and they're backing incredible businesses. I mean, London is not London, but the UK actually, because they work nationwide. There are so many great ideas going through the country at the moment, and it is disappointing to see firms deciding to list elsewhere. And so I would like to see us doing more to make the UK a more attractive place for firms to list. But I could talk all day, and thank you for your time and for explaining that to me and anybody who listens to this. And I hope we can meet up for a coffee or beer soon.
Sure. No, thank you very much for having me.
Cheers, Mason.
Cheers, Simon. Thanks.